Hi, I'm Jimmy. In this video, I'm going to walk through some of Warren Buffett's main holdings to see how much of a value investor Warren Buffett really is. Now, I'm sure we all know that Buffett is big on holding stocks for a long time. So I was curious if he really bought stocks that were out of favor, or as Warren Buffett himself puts it,
you want to be greedy when others are fearful, and you want to be fearful when others are greedy. It's that simple.
Okay, so what I did is I looked at some of Buffett's biggest holdings and then tried to identify when they first invested in that particular company. Then I went back to that time period and to see if we could calculate what the price to earnings ratio was back then. That way we could try to see what Buffett saw at the time. And then we did the same thing for the stock market for the same time period. That way we had something to compare it to. Okay, so let's jump right in. So right now, one of Buffett's largest holdings is Apple. Now, Buffett has raged on and on about how much he likes the Apple brand and how loyal the Apple customers are. So this is a 5-year chart of Apple stock, and Berkshire Hathaway got involved in this during 2016, right in that time period. Now, Buffett has come out recently and said that the average price for Apple stock is somewhere near 142. So clearly, they've added some shares since the early days when they first started buying the company. But if we were to focus just on the early days when they first started buying it, well, Berkshire, when they paid for Apple stock, they paid about 12 times earnings per share. So they had a PE of about 12x. The S&P 500 at that same time had a PE of about 19x. So clearly there's some value there. Now, if we were to fast forward to today, well, Apple's currently trading at a price to earnings ratio of about 19x, which is almost at the S&P 500's current level of about 20x. So it makes sense that this would be one of Buffett's largest positions since he got such a good value early on. And at that time, what I'm guessing what he saw was a solid business with a great brand and was trading at a discount to his calculation of intrinsic value. And it's likely that at some point that would be valued near the average of, in this case, we'll call it the market, of about 20x. Now, I was curious what a good value really was. So assuming we stick with price to earnings for a minute, I mean, what if the S&P 500 is currently overvalued? Then the 20x doesn't make a lot of sense. So I pulled down the average PE for the S&P 500 going all the way back to the early part of 1970. And that number came out to be about 17x. And I was curious what a really cheap stock looked like. So I went back to the bottom of the Great Recession. And at the bottom, the S&P 500 had an average PE ratio of about 11x. Now, it didn't stay there for too long. A month before that, the PE was at about 14x, and a month after that, it was trading at 15x. So it didn't stay there terribly long, but now we have an idea of some averages, some lows, and the current level. Okay, moving along. Next up, we have Coca-Cola. Now, Coca-Cola, Buffett started buying Coca-Cola during 1988. And at that time, he said that he expected to hold Coca-Cola forever. We can see that once again, Buffett's PE ratio was lower than that of the stock market at that time. They paid about 14 times earnings, and the S&P 500 was trading at about 15 times earnings. Now, it's probably worth noting that this big purchase of Coke came shortly after the stock market crash of 1987. So that seems to be a theme throughout a lot of Buffett's biggest buys. Okay, up next we have Buffett's purchase of American Express. Now, American Express is an interesting one because Buffett first bought into American Express back during the 1960s when he had Buffett partnerships. And back then, that was right after they had a big scandal called the Salad Oil Scandal. So I'm guessing he got it for a good deal. Now, his current stake in American Express started in 1994. And at that time, he paid about 10 times earnings. So they had 10x, and the S&P 500 had an average of 21x. So clearly, this was a pretty good deal, and it makes sense that he's still holding this investment today. Okay, up next we have Kraft Heinz. Now clearly we could see that back in 2013 when Buffett first bought Heinz, back then it was called H.J. Heinz, well clearly the stock looked to be overvalued, but Buffett didn't actually buy the common shares back then. He bought preferred shares and they paid him 9% on an annual basis. So yes, the common was overvalued relative to the market at that time, but that doesn't account for the dividends that the preferred shares are paying. Now, the story turned worse for Buffett because a few years later, him and another group pushed for the merger with Kraft. And in 2015, they finished the merger and the company became Kraft Heinz. Well, Since then, Buffett has admitted that they overpaid for Kraft, although he says that the deal that he originally made with Heinz wasn't a bad deal with the 9% preferreds. And since then, they've converted their preferred shares into common shares, and they ended up having to take a write-down because, once again, they overpaid for Kraft. Okay, up next we have Moodys. Now, here we could see that at that time, the S&P 500 was trading at a pretty high level compared to pretty much all of our markers. And what they paid for Moodys was a bit too high compared to the market as well. Now, it may be no surprise to us that this is one of the positions that Buffett has trimmed down over the years. I'm guessing because they probably didn't get the return that they were looking on their initial investment, which looks like they may have overpaid for it. Okay, now we're moving along to Delta Airlines, which was trading at that time at a huge discount to the market. And this just recently happened it was at the tail end of 2016. Now, when we switch over to the chart for Delta, well, we can see that they were buying right in this time period. So it would make sense that I'm guessing this is something that Buffett was watching for a while, and then they jumped in and started buying as the entire industry pulled back. If nothing else, Buffett seems to be fairly disciplined. And during that time period, Buffett bought a few other airlines as well. So he must have liked the entire industry, and he saw the entire industry pull back. Okay, up next we have another one from the same industry, Southwest. So once again, it looked like a good deal relative to the market, and he bought this one a few months after he started buying Delta. Okay, up next, Berkshire Hathaway goes out and buys General Motors. They bought them back in 2012. And at that time, they paid about 6 times earnings, and the market was trading at about 14 times earnings. So once again, it seems that Buffett has been fairly consistent with paying less than the overall market. He seems to be pretty patient and waiting for a good deal. Then we slide down to the next one, and that's Visa. Now, I'm actually a big fan of Visa and MasterCard, and we might as well expose the next one since Buffett went out and bought both. Now, we started both of these positions back in 2011. MasterCard in early 2011 and Visa towards the end of 2011. Buffett credits his sort of second in command, Todd Combs, for finding both of these investments. And he says today that he regrets not buying more at that time because he believes that this is a great long-term business and that this is where much of the internet and online transactions and transactions in general are going to go to. So perhaps that explains why, relative to the market, he slightly overpaid for these. So in that scenario, I suppose it would make sense to overpay slightly if we believe that the long-term business is fundamentally strong. Okay, now I'm going to expose the rest of these all at once, since the rest of them are all banks. And as we could see, each one of them were bought below where the stock market was currently trading, where their PE was currently trading. Wells Fargo, as an example, was bought back in 1991 after the banking sector in general had gone through some issues in 1990. Buffett said that they had done a bunch of foolish loans. And I was surprised by that because I always thought that Wells Fargo was one of those companies that you could trust to make solid business decisions with the highest level of ethics in all of business. You know, it's nice to finally have a bank we can trust. Okay, I'm just playing. Either way, Buffett seems to love banks, and he tends to buy them when they are trading at a discount to the market in general and when they tend to be beat up. The best example of this purchase came with Goldman Sachs. So during the Great Recession, Goldman Sachs and pretty much every other financial institution was in a lot of trouble, and they were doing whatever they could to get some cash. They needed money, and getting the backing of the world's greatest investor was likely going to go a long way in shoring up their company. Well, because they needed the cash, a lot of companies were willing to cut very favorable deals with Buffett. So in 2008, Buffett invested $5 billion in Goldman for preferred shares, and they gave him a 10% annual dividend. And they also they gave him warrants, which allowed him to buy the shares of the stock at $115 per share. They're similar to options. Those options expired, or those warrants expired in 2013. They had to buy the shares by October of 2013. And before the warrants expired, well, clearly Buffett exercised his warrants. And after a few years of collecting about $500 million a year from Goldman dividends, well, he gets to buy the shares at about $115 per share. And at that time, they were trading at $160 a share. So he netted a fairly huge profit fairly quickly. So clearly, this is one of those deals that only Buffett could have pulled off. But I do find it interesting how much activity he seems to have whenever the market tanks or even if an industry tanks. And for me, this is the real takeaway from this entire analysis. Yes, Buffett seems very committed to value, but he's also consistently buying companies when they appear to be a good deal. He seems to wait, generally, for a good deal. But I also think it makes sense for us to look at companies in an industry that seems to be distressed, especially if it's distressed temporarily. And if our holding period is long enough, I would expect that most of us could do quite well, assuming that we do our research and we understand the business and the industry well enough. I would expect for most of us would have the ability to beat the stock market. But what do you think? Do you have the same takeaway from this analysis as I do? Do you have any takeaway besides buy companies that look to be cheap? Please let me know what you think in the comments below. If you haven't done so yet, hit the subscribe button, hit the bell icon, hit the thumbs up, do all of that. Thank you for sticking with me to the end of the video. I'll see you in the next video. Thanks.